Folks, welcome back to the Contrarian Trader. This is Robert Desmond. It is Sunday, January the 10th, 2010. Folks, I received a number of emails after Friday's earnings report had come out, and there was a lot of confusion as to why the market would have rallied on such poor news. We had, you remember that back in November we had jobs growth of, what was it, 11,000 jobs, and in December we gave it all back plus some and came with 85,000 jobs lost. So why would the market rally? Well, it just goes back to what I've been saying for months now, and it's that this market there are no fundamentals. It's a rally based on cheap money. It's a rally based upon the Federal Reserve printing money, keeping interest rates low, and a weakened U.S. dollar to help exports. That's it. It's as simple as that. If we have a rising dollar, you see what happens to the market. It gets weak. It can't take a strong dollar. Uh, it's it, it's just shocking to me how many people are buying into the fact that this economy is actually recovering. It's not. There is no recovery. They love to say it on TV, but there is no recovery. I'll give you, for instance, they reported last quarter's GDP to come in at 3.5%. You remember then they had to revise it down and then revise it down again. So let's say it was 2.2%. And even that I doubt. Okay, but let's just say it's an honest number. It's 2.2%. That's the first time in history that you've had the first quarter coming out of a recession that the economy comes in at 2%, 2.2%. Are you kidding me? It usually comes in at 5, 7%. That's how you see an economy that's earnings driven come out of recovery. It's because corporations are slimmed down to the bone. They've cut costs, they've cut jobs. Now their orders pick up, everything dropped, those earnings drop to the bottom line, and boom, you just get an explosion of production. You get an explosion in earnings. That's why you see PE so high right before a recovery. So we need to be aware of what's driving this market, and Friday's action was a perfect indicator. I am willing to bet you if that number would have come out of gain of 1 million jobs, you would have seen a reversal in the market. That's because there would have been a fear in the market by traders that the Federal Reserve was going to have to act quicker, and they would have to raise rates. But as it turns out, because you had that jobs number that came out, they're not going to be forced to move as quickly. Even though they say there's no inflation, I don't know if you've been to the supermarket lately, but those boxes, although the prices aren't going up that high as much as you might expect, the boxes are getting smaller. That's inflation. Um, we the one other pressure that's going to be on this market coming up soon is you had a Federal Reserve President Eric Rosengren came out on Friday, I believe, and he said that the $1.25 trillion worth of purchases by the Fed of mortgage-backed securities was going to come to an end in March. And the effect of that is going to be an increase in interest rates of up to, say, 0.75%. Now, what's going to coincide with the end of the buying of MBOs by the Fed is going to be the expiration of that first-time home buyers credit. So that's going to end in April, I believe, April 30th. So March, you're going to have the Fed stop buying up mortgage securities, which helps to keep mortgage rates artificially low. And then you're going to have an end to the tax credit, unless they extend it again, which I would be surprised. This government wants us on welfare forever. Um, that's that the first-time home buyer tax credit is supposed to expire, and what's going to happen is you're going to have a rise in rates. You're going to have the incentive to purchase a home taken away due to the fact that you have a rise in rates and the credit's gone. It's going to make it harder for people to qualify for those mortgages. What's going to happen? You're going to have either people are going to have to lower their prices yet again, or you're going to have people who are going to be priced out of the buying a home because they can't qualify. So keep that in the back of your minds. There are storm clouds that remain on the horizon. What we are having here is a phantom recovery. It's like a drunk with a spike punch bowl. He's having a great time, and so you take that punch bowl away. You take away that punch bowl; it's got booze and sugar in it, and man, he's going to crash like a rock. So, if you're short, reevaluate what you're doing because you're fighting a losing battle here. I'm short a couple of positions myself, and I'll be discussing this with my subscribers how we plan on handling this market. Let's get to the charts last week. The S&P 500. I was taking a look at the volume. It came in below average, no surprise there. But on the ultimate oscillator, you saw a inverted head and shoulders form on the ultimate oscillator at the 50 level. That's significant. That means that the cheap money is going to be chasing this market even further. So our prediction going into the week is that if we make a new weekly high, you're going to see a continuation of this rally going into the week, and barring a geopolitical hits to the economy, we could see 1,200 on the S&P 500. I wouldn't be a bit surprised, folks. We've hit all of our targets before. I've drawn a new price target, and it's at or about the 1,200 level. Let's take a look at a couple other charts. The retail holders. I've mentioned that this is one sector that's due for correction. On the past couple of trading days, you're seeing reversals. It looks as if they want to take this index higher. So if you're thinking about getting long short the RTH, I'd hold back on that until you break below this resistance level here, or it rallies up and fails to break above this. Let me backtrack. If it breaks below the support level here at say 93.50, you can open up a position, or if it fails to break out above the 96.11 level, which is resistance, then you can add your positions there. So please be careful if you're thinking about getting short. IWM, they're breaking it out. They did so on declining volume, which is a concern, but I'll be honest with you, if it makes a new weekly high and volume holds in there, you can see a continued rally on the IWM. You can't fight the cheap money, folks. With XLF, you're seeing an attempted breakout here of the 1570 level. It was a very light trading week last week. If you see volume come in higher, then you can expect that we're going to break out and we're going to head higher. There's no fighting it. Take a look at Goldman Sachs, bearish here. I'm wondering whether or not because they're going to drag this Githner in front of Congress at the end of the month to explain why his involvement in getting Goldman Sachs bailed out through that AIG bailout via the AIG bailout. You'll remember that AIG was owed Goldman Sachs $13 billion. If AIG would have gone bankrupt, Goldman Sachs would have gotten zero. So while all the other creditors who were owed money by AIG were paid percentages of what they were owed, in essence, pennies on the dollar, Goldman Sachs got 100% of their money. Unheard of. We are being robbed blind in this country. It's absolutely a travesty what they are doing. So watch for this guy. I wouldn't be a bit surprised 3 months from now, 4 months from now, that Githner is no longer in office. He's out. I'm predicting that Githner is going to be out. Thank God. Let him go work for Goldman Sachs. Fuck that he is. And you know what? They wouldn't hire him. Folks, that's pretty much it for this week. I'm not feeling all that well, so I'm going to cut this short. We did have some issues with the website this week. I apologize for those issues. I will be keeping in contact with my members if there are any other developments with any email problems. Folks, for those who are not members of the Contrarian Trader, please sign up for the 14-day free trial offer. You can always cancel whatever you want. I think you'll find it valuable. I will be getting some Contrarian member privilege commentary out to them this evening or tomorrow morning, one of the two. But I'm going to start working on that immediately. And so wait for a commentary from me coming to you via email. That's for the members. If you're interested, please sign up for the 14-day free trial offer, and we'll get you that as well. Also, we're on Facebook now. You can find the link on our homepage, and sign up for my channel. Please sign up for the channel so you can get notified when I do put new videos up on YouTube. Okay. Thanks. Have a great trading week, folks, and be careful with going short right now. It's our prediction that if we see a new high on the week, the market's going to continue rallying, and we could very well see 1,200, assuming we don't have a geopolitical nightmare that hits us. Bye, and have a great trading week.